Animated oil barrel bouncing on screen. Narrator: have you ever wondered why oil prices suddenly go up or crash overnight? Why does gasoline become expensive one month and cheaper the next? And who actually controls oil prices? In today's animated beginner's guide, we're breaking down exactly how oil prices really work in simple terms. Let's start from the basics. Oil is one of the most important commodities in the world. It powers cars, airplanes, factories, electricity production, and even plastics. Because oil is used everywhere, small changes in supply or demand can move prices dramatically. That's why oil is called the blood of the global economy. Oil prices mainly depend on two forces: supply, how much oil is produced; demand, how much oil the world needs. When demand is higher than supply, prices go up. When supply is higher than demand, prices fall. Example: if global travel increases, more fuel is needed, demand rises, oil prices increase. If the world enters a recession, factories slow down, demand drops, prices fall. Simple economics. Now here's where things get interesting. A group called OPEC plays a major role. OPEC stands for Organization of the Petroleum Exporting Countries. They include countries like Saudi Arabia, Iran, Iraq, UAE. These countries control a large portion of global oil production. If OPEC reduces production, supply drops, prices rise. If they increase production, supply rises, prices fall. That's why OPEC meetings can move markets instantly. The United States is also one of the largest oil producers in the world. Through shale oil production, the U.S. can increase supply quickly. When U.S. production rises, it can push prices down. So oil pricing is a global power balance between OPEC, United States, Russia, and global demand. Oil isn't just physically traded, it's also traded on financial markets. There are two major oil benchmarks: Brent crude, WTI, West Texas Intermediate. Traders buy and sell oil futures contracts. If investors expect shortages, prices go up immediately. If they expect oversupply, prices drop. Sometimes prices move based on expectations, not reality. Oil prices can spike because of wars in the Middle East, political tensions, natural disasters, sanctions, economic growth. For example, if a major oil-producing country faces conflict, supply fears increase, prices jump. Oil markets react very fast to global news. Oil prices affect stock markets, inflation, energy stocks, airlines, transportation companies. When oil rises, energy companies usually profit. When oil falls, fuel-heavy industries benefit. Smart investors always monitor oil trends. So now you know, oil prices are driven by supply, demand, OPEC decisions, U.S. production, global events, and market expectations. Understanding oil is the first step to becoming a smarter energy investor. If you found this helpful, subscribe to Energy Investor Pro for more animated energy investing guides. Smart energy, smart money. See you in the next video.